Hello everyone, welcome to another financial analysis video with myself, Moeed Amin, and my colleague, Ted Wayman. Today we are looking at a very well-known brand, so Starbucks coffee. I don't think they need much of an introduction, I hope they don't, but worth giving one just in case. So essentially, chain of coffee houses and what they say, roastery reserves, headquartered in Seattle, Washington. Now, as you can see here on the notes, as of November 2021, this company had 33,833 stores in 80 countries, which is a large number. And just over half, or maybe about half of that, so 15,000 of which were located in the United States. Now, what's interesting to note is that they released their quarterly earnings, their Q4 earnings, on the 1st of Feb. You know, as you will have read, and hopefully if I encourage you to read that, you know, they're still affected by Omicron. Not a huge amount, but certainly enough for the financial community to be disappointed. So their shares went down by 3.5% on that very day. Now, we're not going to look into those future details, etc., and help you analyze whether you should invest in a company like this. The purpose of our show is to improve your financial literacy. So learn how to read and analyze financial statements to draw inferences and conclusions that you can use in your investment thesis, or if you're selling to them, or if you're thinking about joining them as an employee. We'll talk about that later on. So stick around in terms of the shares as well, because if you'd invested in them in 1992, when they floated on the stock exchange, you would be sitting on a 28,000% profit. So of course, benefit of hindsight, but in the last 5 years, they have grown by 70% with quite a few ups and downs. So stick around because we're going to come on to that later on. Actually, this was a request as well from one of our viewers. So Timmy Pompom, thank you, Timmy, for your request. So here's your video, and I'm sure you'll find it useful. So Ted, let's take it away and share what we found out about this well-known brand.
Hi, yes, thank you very much, Moeed. Great to see you again. And just a quick note to our viewers, hello to everybody. Please don't forget to like, share, and subscribe to the channel. Obviously, if you subscribe, you then get the notification. And if you do make a recommendation for a company and we manage to review it, we do get lots and lots of requests. But we do try and listen to those requests, and if you do make a request and you're subscribed, obviously you'll get notified about it. And if you do make a request, do give us a little bit of background as to why you're making the request. So you can just, like Timmy Pompom, just say, oh, can you look at this company, and that's fine. But if you give me a little sort of feel as to, are you an investor, potential investor looking to work there, currently working there, looking to supply there, looking to sell to them, give me some a little bit more depth. Obviously will maybe push you up the priority list. Now, before we look at the financials, just a little bit of interest about Starbucks, looking at the old logo. So the logo has changed. Obviously, this mermaid. You'll notice that the beginning, right at the beginning, it was very much a kind of a topless lady, showing what a topless lady would show. That was obviously by 1987. If we're going to take this mainstream, we've got to kind of clean it up a little bit. So it goes off to the kind of the new version, which is over on the right hand side, you can see, but still the tummy button can be seen. And actually we decided from 1992 that the tummy button was no longer viable either. So that has been removed in the current logo. Anyway, that's just a completely aside, nothing to do with any financial analysis, but I thought that'd be quite interesting to share with you. So here are Starbucks. Here are the financials, and we are looking really at their 10K. And so let's go down, and the 10K, as every 10K has lots and lots and lots of information, but we are going to scroll down to the consolidated financial statements, and we're going to find them. Here we go. So we just keep going down. We should find them. I think I may have gone too far. So here are the financial statements, and we are looking at the income statement here. You'll notice that we are dealing in millions, so millions of dollars. So when we look at the revenue of the company, so for example, we're looking here at the year ended October, sorry, the year ended basically the end of September 2021. We can see the total revenue for the company is 29,000 million. That's $29 billion. They are really operating their own stores, but there's some franchised stores as well. So this is going to be sort of franchisees, and then there's other bits and pieces that they are making money from as well. But predominantly company operated stores. There's the sort of the big number. You mentioned, Mo, you mentioned the pandemic. So here's the kind of the year ended 2020, when they saw, they did see an 11% drop from the previous year. So revenue dropped by 11%, but it has definitely come back, and it's now up by 24% year on year. So, probably, and I'm guessing here, what happened is that, the pandemic goes in, everybody closes, everything's shut, and then, Starbucks again, well, hold on a sec, we're providing, a vital service, and, we're feeding the nation, and it's going to key workers, and everybody who can try and be a key worker is, and then they sort of start to open up and provide. So, while you have lots of companies in lockdown, it looks to me like Starbucks were not in lockdown, and have done very well. So, people staying at home, bit of extra cash, going to treat myself, and they pop into the local Starbucks. Now, next interesting thing to notice on this, let me just clear those drawings, is this number here. This is the product and distribution cost. So this is the cost of the coffee and shipping it around. That is a really, really low number. Okay, that's about 30% of the sales, which means that they're making a 70% gross margin, which is very high indeed. So when you buy a Starbucks, in fact, when you buy any coffee, the cost of the coffee is negligible. It costs them almost nothing to actually put the coffee in. It's kind of for every $3, if you're paying $3 for a Starbucks, it's costing them, something like 90 cents to actually put the coffee. That's the cost of the actual coffee. Everything else is effectively gross profit. But you'll notice that they've got reasonably high store operating expenses. So this is going to be, if they don't own the stores, it'll be the rent, and the light and the heat, and and all that kind of stuff that you'd expect to go with it. Little bit of depreciation going on. There's the general and administrative expenses. So that's kind of their back office, finance team, HR team, and all the kind of, the sort of senior managers and people who kind of, answer emails and all that kind of stuff, et cetera, et cetera. So coming down to our total operating expenses, we then end up with our operating profit. They call it operating income. So the operating profit here is just shy of 5 billion, and that's about 17%. You'll notice quite a big hit in the previous year. So the costs, the fixed costs of running the business, didn't really change, but the revenue, obviously took a big hit. So they went from 4 billion down to 1.5 billion, and now they're back up at nearly 5 billion. So looking pretty healthy there. And then Starbucks, very bad reputation here in the UK from their kind of tax avoidance. They ship the coffee. I think they ship it into the Netherlands, and then they sell it almost at a kind of they ship it into the Netherlands, and then they sell it at cost, also at the cost that they sell it here in the UK. So if you go into Starbucks and you buy a Starbucks coffee for, I don't know what you pay, £2.70 here in the UK, the coffee costs £2.70 effectively, which means that they're selling it at what it costs them. They make no profit here in the UK, but they are making profits. They're making profits elsewhere. So this is the way companies like Starbucks can move profits around, and what they're trying to do is to make the profits in places where they pay less tax. Okay, it's a kind of tax avoidance rather than tax evasion, one of which is legal and the other of which you will go to jail. So it is legal, but they are paying tax, and their effective rate of tax is, around about 20%. So this is the kind of this number here. So they're paying a rate at about of 20%, which looks about reasonable. And here's their nice strong profit. Okay. Now you mentioned that the markets weren't happy about that. So don't forget that Starbucks will talk to the markets. They'll say this is what we expect, and then the question is, does it disappoint, or do they meet expectations? So if the markets are expecting 5 billion and they only do 4.2 billion, then the market's going to say, oh, I'm not very happy about that, and maybe the shares will sell off. But 4.2 billion looks pretty good to me on these numbers. That's a 14% net margin. So for every dollar they sell, effectively the shareholders are making 14 cents in the dollar, which is a pretty good margin, and it's a pretty good business. Let's go and look at the balance sheet. Here's the balance sheet. First thing we see in the balance sheet, so the non-current assets are all these bits here. So these numbers here, that's all the sort of the non-current assets. Big numbers are property, plant and equipment. So this will be all the kind of fixtures and fittings they've got in their stores. If they own some of the stores, maybe they've been buying, rather than leasing stores, they'll actually buy those stores. And then they've also got this operating right of use assets. So if you think about, if you go into a Starbucks and you see the coffee machine, they may have bought the coffee machine, but they may actually have the coffee machine under kind of a hire purchase agreement. Okay, and if it's a hire purchase agreement, it's kind of you hire it and then buy it at the end, and therefore if you're hiring it, you don't own it, so it's not an asset. But change in accounting laws, you have to now put those assets on your balance sheet. So that's really effectively what those are. So we can kind of take those together as their fixed assets. That's really it. A little bit of goodwill, which means that they've been buying. It's not just Starbucks that have bought a few other companies, and they pay a premium to the fair value of the net assets. And then up at the top, the current assets, this section up here, really just jumping out as lots of cash. In fact, I'm going to circle both of those numbers. Those short-term investments is effectively cash as well. So these guys are stuffed full of cash, lots and lots of cash, which will help them to deal with any future pandemics as well. Accounts receivable, pretty small, but that's because we tend not to buy our coffee on credit. When you pay for it, you walk into the store, you actually pay for it, and then they've got the inventory. These are all the coffee beans that they are using. So there's the assets side. Scrolling down, I'm quite interesting now because we get into the liabilities. Now here we've got the current liabilities. Some interesting numbers coming out here. So accounts payable, those are our suppliers. That's absolutely fine. A bit of sort of payroll and kind of accrued liabilities. That's all fine. This is the current portion of the lease liability. So just to make it clear, let me clear this. So if we take this number here, this is the kind of the lease payments they have to make quite soon, and the lease payments they have to make next year. If you remember, the current liabilities are things we have to pay soon, and the long-term liabilities, which are these bits here, are the stuff that we pay next year and the year after and the year after. So those two numbers together are kind of matched to that the assets that we have, the kind of right of use assets that we saw earlier. So that's absolutely fine there. We've got now, what's also interesting is they got debt and no short-term debt. They did have some short-term debt, but they got rid of it. But they do have quite a lot of long-term debt. Okay, it's less than it was in previous years, but about $13.6 billion of debt, and that's fine. They're profitable, and we can see, as we saw in the income statement, just bounce back up the income statement quickly. We can see the interest that they're paying on that debt. So there's the interest they're paying on it. And they're easily able to afford that interest. So really, having that debt is not an issue for these guys. However, what's also interesting, and I have to admit, I don't really drink at Starbucks. So quite frankly, the cost of the coffee is high. But anyway, what's interesting is this number here and this number here. Now this is deferred revenue. So this says store card liability and current portion of deferred revenue. So store card liability. So if you think about it, every time you go into a Starbucks, they have these store cards and they stamp your store, and they're going to say, if you buy 58 million cups of coffee, we'll give you one free. Or what is it, sort of, you buy 10 and you buy 9 and you get your 10th free, or something like that. Okay, well, they have to account for that as a liability. So every time you stamp the card, they owe you 1/10 of a cup of coffee, and they have to account for that. And that's effectively where that kind of part of that store card liability. But what's really interesting is the current portion of deferred revenue. So deferred revenue says it is money which you pay today, and you get the benefit tomorrow. So deferred revenue would be something like a prepay on a SIM card. So if I prepay my SIM card, the telco company cannot recognize that as a sale when they sell the SIM card. They recognize it as a sale when I actually make the phone call. And therefore, in the intervening period, they have to treat it as what they call deferred revenue, i.e., if they cease trading, they got to give the money back to me. So Starbucks have nearly $6.5 billion of deferred revenue, and I have to admit, I scratch my head, and it's long-term deferred revenue. They don't have to give it back next year or the year after. Now, maybe this is my lack of knowledge of their operating model, but I'd be really interested if there's anybody out there who knows exactly what that deferred revenue refers to, whether I've missed something. Is it prepaid store cards? Are people buying, is it they're buying membership of it's the fact that it sits in the long-term liability rather than the short-term liability. I can get that, you might have a store card which you prepay or you load and then get discounted coffee, but this long-term liability I can't get my head around. So if there is anybody watching would like to kind of share their understanding of that, then please do so. Anyway, the point is that this is very good for Starbucks cash flow. So what you're going to see here, this deferred revenue, very, very good for their cash flow, so that's a good thing for them. What's also interesting then is, so not only is the current liabilities, very similar to the current assets. So liquidity is not an issue, and with things like this, they got very strong cash flow, which will allow them to operate at maybe slightly lower current ratio. That's where the current liabilities compared to the current assets. But what is interesting is down here, you notice they've got this big deficit. So the equity, the liabilities themselves, let me just do this in a different color so we can highlight it. So the actual liabilities of 36.7 billion are greater than the assets. Okay, so these guys are technically insolvent. I use that word technically because they're not actually insolvent, because they're generating lots of cash, they're very profitable, and they can meet their obligations as they fall due. But their balance sheet has gone negative, and usually that's a warning sign. It's just not a particularly nice place to be, but they are, and it's quite interesting as to actually why they've gone negative, and I'm going to show you that in a minute. In fact, I'm going to show it to you now. So here we've got the movement in equity. Now, the movement in equity, what we're going to be doing is looking at the retained earnings section, which is this one here. And this is 3 years ago. 3 years ago, they made a profit of about 3.6 billion. And look what happened here. They used 9.5 billion to repurchase their stock, and they paid out dividends of 1.8. That immediately puts them into this negative. Okay, so it looks to me like it's a slightly bizarre thing that they, there's a conscious decision to cause the balance sheet to go negative by buying back their own shares and booking those through the retained earnings. And then, if we scroll forward to the next year, again, a little bit of a profit. You remember that was in 2020. And again, a lot of share buyback and a big dividend. And in this year, they actually make a profit. And the dividend, well, they're not doing any share buybacks. The dividend has gone up, but it's lower than the profit, and therefore the deficit now has reduced. But still really interesting as to this big share buyback, which is driving this negative balance sheet. You'll notice, I'll just highlight it on the right hand side here, that they started 2018. At the end of 2018, they had a positive balance sheet, and since then it's been negative. So just quite interesting there, and not you know, let's not alarm bells or anything. It's just, you know, it's just something to be aware of. Here's the cash flow. As we would expect, you know, very, very strong cash flow from these guys. Here it is. We're looking at these numbers down here. So they're generating 5 billion, 1.6 billion and 5.7 billion. So their cash flow is higher than their profit. And the reason for that is because there's deferred revenue and they're getting a lot of cash in up front, which is good for them. What are they doing with that cash? Just scroll down the cash flow statement a little bit. Here we go. So we've got the this is the investing going on. We do need to remove these bits here. So this is kind of, and we see this occasionally on businesses where they're buying investments, selling investments, maturities. That's just parking money in a deposit account and taking it out of a deposit account. They're not investing. So, you know, when we look at the cash flow, ignore those lines, just going to put a line through that like that, and focus on, you know, buying property, plant and equipment, and buying and selling businesses effectively. And then down the bottom here, we've got the kind of the financing activities. Let me just clear those that animation so it makes it clearer. So down the bottom, we've got the financing activities. So what are they doing? So repayment of commercial paper, that's basically repaying a loan, and then issuing debt. So this is kind of refinancing on a short-term debt. In fact, these three numbers are refinancing. And then up here we've got some so you've got some repayment of debt. There's the dividends coming through, so we can see that very obviously. There's the big kind of repurchase of their shares in previous years. Issuing debt, you can see that coming here. You know, they've been paying back, they've been reducing their debt. So, you know, they're basically you know, they're reducing their debt, and that's having a negative effect on their cash flow. But even so, they're generating lots and lots of cash, and that's why they end up with more cash at the end of the year. So summary, these guys, you know, not too much debt. They got very strong profit margins, EBITDA margin 22%. You know, very, very happy with that. You know, you know, they did grow by 25%, but then they did shrink by 11%. So you know, there's a dip in there. So you know, if we look at the income statement and we look at the growth in the earnings per share, the EPS, it's gone from 0.79 to 3.57. That is a massive growth rate for the investors. But I'm not sure, you know, that's a kind of, you know, 354% growth rate, but I don't think they're going to be growing at 354%. So I wouldn't necessarily use that on my PEG model, my kind of price to earnings growth model. Nothing else really to kind of highlight in these guys. So I'm just going to clear the animation, and then we're just going to go and have a quick look at their share price, Moeed, as you were referencing. So here is their share price. So absolutely, if you'd been one of the lucky investors right at the beginning, you would have made an absolute fortune. Congratulations on the benefit of hindsight. Looking at it a little bit more recently, here it is. It's been, you know, it has been rising. It has been a rocky ride. So we can see, you know, very quickly, you know, there's the pandemic hitting, and everything takes a tank. And then actually people go, you know, we think that these guys are going to benefit from the pandemic, and it's all the way up the top. And then I don't know what's going on. Maybe the earnings are disappointing, and it has taken a little bit of a tumble. Price to earnings ratio is 25 times earnings, which makes it, you know, expensive. That's a kind of, you know, if we talk about that in terms of the earnings yield, that's about a 3.8% earnings yield. But these guys are, you know, they're not jam tomorrow, they are a jam today business. However, you know, be quite interesting on you know, maybe some viewers' thoughts on this. Are they a luxury? So, you know, do you really need your Starbucks fix at the beginning of the day, or as interest rates are rising, inflation is going up, price of commodities, fuel bills are going up, you know, is that kind of that $3 a day luxury? Is that going to become a, you know, a sort of, you know, is that going to get, is that going to be reduced? So do these guys sit in the luxury? Do they sit in the necessity part? I don't know what the answer is to that. But it's going to be interesting to see, you know, if you're thinking about, you know, if you do spend $3 a day, that's $1,000 a year on coffee. And if your heating bill has gone up by $1,000 a year, well, you can do the math there. Dividend yield 2%, looks pretty good. No reason why they can't maintain that dividend. So again, it's not too bad, but as interest rates start to come up, that dividend yield is going to look less and less attractive. So there we go, Moe. That is effectively my kind of analysis of Starbucks. Not a lot I can sort of add to that. Is it a good investment? I have no idea. It doesn't look a bad investment. It's not a screaming buy. It's not a screaming overvalued. It's expensive, but it's not jam tomorrow. And I think that's an important aspect. But are they going to be able to weather an economy where as I said, are they a necessity? Are they a luxury? I'll leave my viewers, our viewers, to decide that. So do share your thoughts, put them in the comment section, and don't forget to like, share, and subscribe. There you go, Moe. That's it. That's all from me.
Perfect wrap up. Thank you for that, and look forward to hearing from everyone else in terms of their comments and views here. So do let us know. This is a community at the end of the day. We're all helping each other. So until the next video, thank you, Ted. Thank you, everyone else. We'll see you on the next analysis.
Excellent. Okay, catch you later, Moe.